Thank you so much for joining us here at the big board.
Yeah, glad to be back, Dan.
All right, so let's talk about the impact of the Fed on households, right? So a lot of the market is paying attention to what the Fed does next, and we have this expectation of a rate cut of 25 basis points. How are you seeing it through your lens and its impact to the average household?
Well, the average household, they're seeing it two different ways. I mean, you got monetary policy and you have economic policy. They're going head to head. I mean, we have the dot plot. They're saying, okay, well, we're going to have tepid rate cuts across the year, and the market is going up. And people are asking me, they're like, well, how can the market be going up? And then we're seeing these prices at the grocery store. So the households are seeing two different things. So what I'm hearing is like, okay, well, our portfolios are going up, but jobs are not very secure, and then prices are going up. So what do we do about all that?
So on the jobs front, there is weakness, obviously, and part of that is the reason that we're expecting to see a rate cut. When you look at that, you know, more people working part-time because they have to, what should families be doing to prepare, especially if we're expecting to see more, disruption in the job market?
Right. Well, one of the sectors of the market that's not doing very well is consumer staples. So people are not spending very much. So when we're talking about big ticket purchases, careers, and also job decisions, job decisions, and a couple other areas, and investing. What do people do in these areas? Well, raise some cash, particularly, perhaps as protection as a moat. A little bit. So like in my hometown, Houston, people are getting laid off. So what do you do about that? Well, you got to take some money out of the market, just a little bit, in order to say, okay, well, what's next for me? And then what about trips, and what about the holidays? Well, have a little cash on hand so you can enjoy the holidays rather than having to react to possibly headwinds that may come if the market doesn't react well to certain headlines that may come up.
Where are those layoffs happening? What industries are you noticing that happening?
Yeah.
Because I know obviously oil and gas is big, excuse me, in your region. Is it that sector, or is it a variety of sectors where you're hearing about the layoffs?
Right, oil and gas for sure. I mean, ConocoPhillips, Halliburton, those are just to name a few. And then when jobs are not adding that many jobs, I mean, we had 22,000 jobs added this last, and the revisions downwards. So that's a steep climb from 100,000, 120, 130,000 jobs. And then we have wage growth that's not even, well, it's above inflation. Inflation's about 2.9 right now, and wage growth is about 3.8. So people are not really feeling, the love as far as their paychecks, as far as their careers are concerned. So when you have these two factors baked in, people are saying, okay, well, I want to protect my pockets a little bit, and they're staying with careers a little longer and not making too many moves, particularly with the turn of the year coming up and having all this, maybe a little bit of uncertainty in the markets, even though we're seeing all these highs.
So people's dollars are, being stretched more, asked to do more, basically do more with less, right? Inflation, that you would read through, is not as hot as it has been. However, prices are still going up. It's just the rate of inflation. What's the balance in terms of priorities and how you're advising clients?
All right. There's a difference between what the market is doing and what people are making their decisions are at home. I mean, the market, it's good for companies. Companies, they're not paying as much as far as increased, raises at the job. That's good for balance sheets. And then also the cost of capital with rate cuts that are happening. Cost of capital is cheap, so companies get to reinvest. So the stock buybacks, those are good for companies. So there's a lot to say for as markets and why the markets are doing well. So people need to stay committed to their investing plan. But also have the courage to pivot potentially if there's headwinds there, and position themselves to make decisions if they, a job loss comes or something to that effect.
What do you say to the people who are nervous with the market being at all-time highs, especially when you think about early career people and say, okay, but why should I invest because it's already at a record? Am I too late?
Well, there's a trend, right? Well, particularly with young folks, because I serve as Gen X in my firm, but I also am a college professor, and I tell young folks all the time, you have the best gift in the world. Time all day long. So stay in the market. You can take a little bit more risk. For those Gen Xers that I serve, you have to stay committed. So you have to stay in the market, and particularly with record highs. We've seen a lot of record highs this year. And what it does historically, the forward 12 months after that tends to continue to be high because the economy, the underlying factors tend to be okay as well. It's not a bear or a bull right now as far as the economy. In the market, it's a bull.
It's definitely a bull market here.
Yeah, right. Bear, not in the economy though. Bear, not a bull, kind of like a bunny. Just just hopping along a little bit.
Okay, you talk a lot about keeping like money and life in balance.
Yeah.
How do you, something comes up often in the market, FOMO, right? We even have a show that you're on regularly with my colleagues, Jenny and Alex, Next Gen Investing. They have a segment called FOMO, right? Yeah. So how do you address that feeling as well? Because that's the flip side of, you know, the records and being scared to get in, chasing that big move.
Right. That takes commitment, and there are 3 C's. Commitment, consistency, and courage. And you get commitment to a plan, consistency in that plan, and having the courage to not look the other way, and comparison. Comparison is the thief of all joy. And my dad always says, he says, listen, horses wear blinders for a reason, so they won't look this way or that way, right? You don't know anybody else's story. Stick to your story, stick to your plan, look straight forward, because once you start looking this way and that way, then you don't have that commitment or consistency, and then you don't have that probably that 4th or 5th C, compounding.
Okay. All right. We'll leave our conversation there for today. Thank you so much. It's Dr. Preston Cherry, founder of Concurrent Wealth Management.